Okay, we are recording. And we're going to pick up where we left off yesterday. We only got through 2 out of the 6 trading strategies that he lays out once you identify a range. So we left off on the fib OTE supported range strategy, drawing the fib, which would be 0.7, 0.8, you know, waiting for the break. I don't need to go over it again. Okay, so let's hop back over.
But breaker blocks, because this is backtested a lot with all my friends. Somehow break
I like that. That's like the badge of approval is, you know, this strategy works with all my friends. They're a very reliable group of people, so. Okay, double manipulation, fib OTE. This next one will be about breaker block. Back tested it a lot with all my friends. So it is this one in particular. It's a good one. Okay, this is this highlighted area is all he says about the strategy, so we're gonna have to kind of deduce the details. I don't think you deduce the details. We're gonna have to I don't know a good word for that. Extract the details from his chart. So just looking at it, I can see we have a deviation from the range to the upside, followed by a market structure break, which creates the breaker block. And then we have a touch of the EQ line, which would also serve as the first take profit after we enter the trade. And then the second take profit would be the lower end of the range. So yeah, I'm not sure what's different from this one as opposed to the last one. We don't see much of a deviation here. Again, these are all just concepts, you know, we don't have to wait for the exact shape that he draws here to play out in real life for them to be good trades. Now, one thing I do also notice is the risk reward for this trade puts the stop loss at the top of the deviation. So if we look back at our fib OTE, oh wow, we don't even have the notes open. Major fail. Come on, Windows button. What was it called? Fib? OTE. Okay, fib OTE range strategy. Alright, I may have spoken too soon. It does look like the highest swing is used as the stop loss in this one as well. Anyways, Now, it wouldn't be completely unreasonable for price to return, especially if it touches the EQ line all the way back to the top of the range. So that's why it's very important to look at the lowest time frame you can for something to confirm your entry. Even though price should be a little bit exhausted after making this this deviation right here. So that's the great thing about using price action as opposed to indicators, is that price will never contradict itself. It may not be immediately clear what's going on, but if you use purely price action, then you can really, as he says, layer as many concepts on top of each other without worrying about conflicting signals. Okay, I think, let me draw some arrows real quick. You know, I need those arrows. Okay, no. Classic 4-step setup. Good bands and good traded setups, you know, they come in 4s. So, first we start with the deviation or significant top at the top of the range. Then we have the price breaks through the previous higher low, creating a market structure break. So even though we don't have the price line here, we can assume this is a higher low, which would make this the MSB level. Price breaks through it, and then we would have the body of the candle. I draw it in here real quick. This is a wick that precedes the movement that creates the break, would form the boundary or the height of our breaker block. And then once it would be an order block all the way up until the point where price comes back down and breaks it. So then it becomes a breaker block, and then we look at it as a supply zone. So after we've got our breaker block created, optional step, because he doesn't draw special attention to the need for price to come down to the EQ line, but I think it would be ideal if it did. So price crosses the EQ, then returns. And then entry found in or near the breaker block on a lower time frame. So once we get up here, you know, we would look for maybe like an engulfing candle, or, you know, miniature market structure break here, and we could be like, okay, let's go for it. Setting the stop loss at the high of the deviation. Take profit levels. I will draw those in actually. This would be the first one. This would be the second one. Of course, that's not a hard rule. If there were, you know, like a big old imbalance like here, just waiting, then that could be a take profit as well. I'll just call this a significant high, because it will be significant.
Then he told me of the significance.
It will be significant.
So we'll call this the range breaker block strategy. And I kind of like this this format I accidentally created, or created without thinking, is the trade name, a short description, and then the steps. So the short description of the range breaker block strategy is just primary entry target is created by a breaker block. I'll take a quick look at the example, but I don't think I'll... what the hell. I'll add in the actual chart examples, which means I'll have to do the one for the fib OTE as well, because I didn't do that yesterday. And we did add an example for the double deviation. So, just to be fair to the other trades, we gotta add them in too. But I need to refill my coffee. Oof, that is a lot of drawing. Okay. Okay, we're back. So let's start to mark out the fib example. Trying to figure out what the exact trigger for entering the long position would be. I mean, we do come all the way down to this fib zone and the imbalance and the order block. But I think the key lies in this price action here, but I'm just not seeing the clear pattern. Well, I won't dwell on it too long. It'll probably become apparent later, or maybe he mentions it in his trading video. Okay, so we'll walk through this example, and it doesn't match his theory slide exactly, but that's kind of the whole point, is that these are meant to be very flexible setups. So I'll try to tie in what we've learned so far about ranges. Which one was it again? Oh, this is the fib. Okay. So we start with our liquidity lines. Moving up from the bottom, we have these higher lows, which represent unrealized liquidity. So they'll act as a magnet when price does decide to come back down, to pull it down into the demand area, which would intrinsically have a bias to push price up. So we have, you know, the intrinsic bias pushing price up once we enter the demand area of the range, and we have the intrinsic bias pushing price down when we're in the supply area, or the if you wanted to call it the premium area, or if you wanted to call this the discount area. So we got this liquidity line, and that's something he mentions, I think, in his first video, is drawing the liquidity lines. Just something to be aware of. And then we come up to the top of the range, and we start forming these lower highs. And the same thing is that in the future, those will act as a magnet to pull price upwards. So higher lows pull price down, lower highs pull price up. We have our Fibonacci zones, or retracements, or whatever you want to call them, drawn out in gold. So we have price cross the EQ line with a strong break, leaving this imbalance behind, actually creating what resembles a drop base rally. We have a imbalance drawn from over here in the initial movement up, and then this would be the demand order block formed from, I think, this red candle. So we have price come down all the way through the imbalance into that demand zone, and then this is something, like I mentioned before, is this is golden fib area. But what exactly triggers his entry? Maybe he goes into a lower time frame. But whatever it is, we can see that there's a lot of supporting factors that this would be a good place to enter the trade. So what specifically you choose as your final confirmation is up to you, I guess. We know we have this imbalance, just waiting for the price to come back and fill it, which it does. Let me go back to the slide to see if he marks out where his take profits were for this. We are pretty close to the EQ line already, so I don't know if he would take profit there, or wait till we get all the way up here, or, you know, take profit in this fib zone here. No, he doesn't say. But yeah, I'll give this a title, and I'll shade in the oh, so he puts his stop loss all the way down here at the previous low. And this trade plays out right away. You know, as soon as he places it, price never really threatens his stop loss. It kind of goes straight up. But, you know, it may, like this area here, see, price can spend a long time just hovering around. Maybe that's not a good example. Okay, so now we'll mark up the breaker block example. Where the hell is the range? Cause wouldn't this be the range up here? Or is it, Alright, I could stare at this all day and only form half an idea of what's going on, so we'll just try to find it in the example video. Alright, I noticed a shortcoming in my own analysis that I will share with you so that you may benefit from where I have failed. Is when he is charting the direction of the price, he's using very broad strokes. If we go back to the way I was looking at this trade, it's the fib, right? On the fib? On the fib. Okay. Okay. Yeah. So you look at how tightly I'm drawing the my price line, this blue line here, very close to the candle bars, which can actually distract you from the direction that the price is moving in. You know, big green line, small crazy blue line, maybe it's not the best thing. So I'll keep that in mind going forward. Is I'll blur my eyes, and if you blur your eyes and you look at a chart, you know, you might actually be able to see it more clearly, if that makes sense. Now, it is possible, just looking at this, you'd be like, what? This is the range? This doesn't look like a range. Yeah, but perhaps, trying to figure out which way my finger is pointing. Yeah, going back this way, maybe there was a lot of price action forming a range to the left of the chart, and he's coming into this area here with the range already drawn. Okay, so what did I learn from that? Hunted liquidity, forming liquidity, and imbalances. He only draws the imbalance here because at this point, you know, half of it's already been eaten up. Here we have those higher lows forming that magnet. I think what was throwing me off was just that the trades occur outside of the range. Just it didn't compute for a second. So, but yeah, you can use price action concepts outside of the range. It's perfectly all right. And in this case, it would be the breaker block. Another thing I'll point out, since I've got you here, is because we are still assuming this is a range and that this is a deviation, is that this whole deviation would have an intrinsic bias for price to go down because we expect it to return to the range, right? So that's why, you know, it's better to look for the short trades as he does, you know, if you assume it's a deviation and not a new range altogether. Always keeping the intrinsic bias in mind. Actually, the imbalance would only be from here. Here we have those equal highs again. So I'll just add this in for emphasis. Equal highs equals liquidity hunt. And this liquidity hunt also serves as the swing failure. Damn it! Keep forgetting to leave the timer on the screen. Where are my magnets at? Gotta add in those magnets. And he doesn't actually enter the trade in the breaker block. He just waits for price to come up to the breaker block. And I can assume this multi-shading of two different shades of green indicates two different take profit points. Okay, for his fourth range setup, he keeps it pretty basic. We're really just looking for waiting liquidity in the form of equal lows, which would give us our final price target. We have the structure down here, whatever it may be, forming the weighting liquidity. Price moves up and exhausts the liquidity at the top end, perhaps in the form of a deviation. And then price begins to return. Maybe bounces off the EQ line, comes back up. We find an entry based on any of the market structure concepts. Maybe there's a breaker block here or something. And then we can be kind of confident that the price will want to return down here because of this juicy equal lows. Yeah. Okay, we are back. Bit studied out, to be honest, but you know, I really I want to start something new tomorrow, so we're gonna push through the remaining 2 strategies. Get the music going again. So the 5th oh, that's interesting. So he's using the oops. The the base of that as the supply zone. All right, yeah, no, this one actually is kind of exciting because it's got so much going on. And the real example is much more informative than the theory slide. But we'll mark this up all the same. We'll give Kaplan credit though, because it is not easy to encapsulate an idea like this one, which doesn't have a definite form. That you can say, hey, look for that, and when you see that, you know, do this. You have to kind of operate based on principles rather than concrete structures or figures. So we do look at this. We see the liquidity here in this miniature range, and he does mention that. Liquidity, triangle pattern. So even though it's not a flat, you know, range like we have here, it is a liquidity channel all the same, just in the form of a triangle pattern. I think we need Monocle Man for this one. To walk through this example. So the basic idea is we are kind of in a range within a range. So our goal is to determine what the stronger bias is, or what the stronger pull is. Are we going to be pulled down, or are we going to be pulled up? So we need to look to the left of this area, and if we look to the left, we identify some sort of structure that creates a supply zone. And in his real example, this is a drop base drop, and so this base here is the structure that creates this supply zone, which would give us the stronger bias. And then we look at this from the perspective of a power of 3, where we have an accumulation, and we're waiting for that that manipulation period, which will drive the price up very rapidly, absorbing all this liquidity. And then we'll have our entry, and then the expansion phase, which would be a move to the bottom of the range. Anyways, that's how I interpret this, this strategy. If we look at the original, you can see that not too much to work with. So I'll call this the range within range strategy. Okay, so this is my summary put into so many words. So we have price creates a range within the range, forming liquidity to both sides. And based on prior price action, we are able to determine which side the break will occur on and place a trade entry. So step 1, identify the stronger bias. In this case, it would be an upside bias because of because of the supply zone up here. Price breaks out of liquidity formation. That would be step 2, and then we enter based on whatever we happen to see. So let's go to the example, because that's where the action's at. Wow, I didn't know that. If you hold down Control and also press the middle mouse button or the mouse wheel down, you can zoom in and out like this. I've always just been, scrolling, but this appears to be a little bit more precise. Cool. New GIMP knowledge. I like it. Okay, I think we're ready to walk through the real example. So let me go ahead and copy the theory slide into the example so I can oops. All right, we have the range within range. So identify the stronger bias. In this case, the stronger bias is formed by the drop-base drop, and the drop-base drop supply zone would be the main pull, or the determining factor for that stronger bias. So then, after the second drop, price begins to form what I call the range within a range. And this range is it lines up with the EQ line of the larger range, and we have liquidity forming on each side. So we have a liquidity formation. In this case, it's a triangle. And each side of the liquidity formation, the upside and the downside, they're both pulling on price. So it's going to break one way or the other. But we have the advantage, based on our knowledge, of predicting which direction it will break. So we predict that it will break to the upside. And we are viewing this as an accumulation. Going back to the power of 3, accumulation, manipulation, expansion. So this is an accumulation, and we have an idea of which direction the manipulation will occur. So it occurs to the upside as we predicted. We enter our trade, and then he puts his take profit down here. I think he puts them at both the EQ line and also the bottom of the range. It goes a bit further, but I don't think there's anything down there that he was looking for, so a win is a win, you know? You don't need to press your luck. So let's put the label on it, and we'll throw this into the notes. Before, after. Before, after. Before, after. All right, let's do this. So this, oh no. Okay, thank goodness. All right. Thought we still had 2 left. We only have 1 left, thankfully. So the catalyst for the 6th strategy is a swing failure pattern, and it looks like it's something we're looking for either at the top of the range or at the top of a deviation, or the bottom of deviation. You get the idea. So we'll have a swing failure pattern, a market structure break, we'll return to the entry zone, and then I'm not sure what this supply is. Maybe it's a mitigation block. because the order block would be way up here. Of course, this could be an imbalance too, you know. Doesn't really matter. Okay, so let's copy this over. Oh, this might be Quasimodo level. Let's go back and look at that. Oh, no, like, come on, it isn't Control F, fine. Yeah, look at that. That's what it was. I knew it was something. It was just tickling my brain. So we have the market structure break, the previous higher high. This is the higher high that is not directly before the lower low, but the one before it. So if we find the one before it, then that's our Quasimodo level, which would be here. Just calling it like it is, guys. Just calling it like it is. Ah, as opposed to the, yeah, I was totally off, thinking it was a mitigation block. Identify previous high, price fails to create the break of structure, where in our example, hey, wait a second. Okay, it does, because we have to assume. Let me draw this in real quick, just so you guys don't think I'm crazy. We assume price looks like this. So this dot would be the break of structure. This being our Quasimodo zone. Ah, we only have 15 minutes left. Hurry, hurry, hurry. Where are we? World's most lazy step. Entry based on market structure principles. But, you know, we aren't really looking for anything specific here, so we can afford to be vague. We'll call this the range extreme swing failure pattern. I'm not sure. Is that how you spell loiters? Price loiters near an extreme of the range. A swing failure pattern absorbs the liquidity at this end of the range. creating a strong probability that price will reverse. Okay, let's read that in not slow motion. Price loiters near an extreme of the range. A swing failure pattern absorbs the liquidity at this end of the range, creating a strong probability that price will reverse. An entry is made based on market structure principles, in this case, a Quasimodo level. I really should mark up that final example, but I'm so tired. Okay, one more cup of coffee and then let's do this. Pause. Stop. Wow, that was actually very easy. Or I'm just really lazy with this one. Oh. The only real point we need to point out is this crazy wick. I mean, crazy. It's all the way up here. Yeah, I'm sure that that set off all kinds of stop losses going back. Anyways, so that creates this level here, which eventually gives us our swing failure pattern. So we have the candles failing to close above it here. And this one may close above it, but we'll take Kaplan's word on it and say that's a genuine swing failure pattern. And then he put his entry, he said somewhere around here. I think he said the in the premium of this mini drop here. Okay, we'll just lazy man copy this over and we'll call it a day.